Good inflation news came out this morning. So why aren't mortgage rates moving lower? That is the question, and the answer tells you everything about where the market is right now. I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. Welcome to this week's Weekend Update. Let's get into it. This week's mortgage rates. Before we get into the market story, let's look at where rates landed this week. According to Mortgage News Daily, the 30-year fixed is at 6.38%, the 15-year fixed is at 5.98%, and the 30-year FHA is at 5.90%. These are national averages and are not an offer to lend. The 10-year Treasury, which is still trading as we record this, is sitting at 4.32% compared to 4.34% last week. A modest improvement, but not yet a signal of a meaningful shift. Technical analysts are watching a fairly narrow range on the 10-year right now, roughly between 4.25% and 4.35%. Until we break convincingly below that floor and hold, the bond market is going to stay cautious. The CPI report, good news and bad news in the same report. This morning we got this consumer price index for March, and this one had something for everyone, depending on which number you looked at. Let's start with the good news. Core CPI, the reading that strips out food and energy, came in at 0.196 for the month. The forecast was 0.28%. That is a meaningful beat. Supercore inflation, which is an even tighter measure the Fed tracks closely, also fell sharply. Shelter costs, which have been one of the stickier components of inflation for the past 2 years, are starting to come into line. Rent readings are getting more realistic. Owner's equivalent rent is still a little elevated, but the trend is moving in the right direction. So the underlying inflation picture is actually improving. Now, the bad news. Headline CPI, the number most consumers and many news outlets focus on, jumped from 2.4% year over year all the way to 3.3%. That is a significant move, and we all know why. Gasoline prices were up 21% in March and accounted for roughly 75% of that entire headline increase. When bond investors see a 3.3% headline number, it's hard to get excited about buying bonds, even when they understand exactly why it happened. That's the tension in this market right now. The data underneath is improving, the headline is not, and the bond market is choosing to focus on the headline. The oil rate connection your clients need to understand. Here's the story underneath the story this week. And it is important context for every conversation you are having with buyers and sellers right now. The Strait of Hormuz remains effectively closed. Peace talks in this weekend in Islamabad, with multiple parties at the table. The outcome of those talks could move markets meaningfully on Monday. A favorable result could result in oil prices lower, which would take pressure off rates. And an unfavorable result, or no result, keeps us in the current environment. Oil moved from $92 during the week before settling back near $98. The market is currently pricing peak inflation in May at around 3.8%, with year-end inflation projected closer to 3.1%. That is not a backdrop where rates move sharply lower on their own. Here's what makes this moment particularly important for your clients. The consumer was already showing signs of stress before any of this started. In February, before the conflict escalated and before oil prices spiked, real personal income actually fell. The savings rate dropped to near its lowest level since 2022. People were already spending more than they were taking in, and now they're absorbing higher gasoline prices on top of that. This matters for housing because a consumer under financial pressure is less likely to stretch for a purchase. It affects buyers' confidence, it affects how quickly people make decisions, and it is something the professionals in this room are already seeing in their conversations. The path to lower rates is not blocked by the Fed. The Fed is actually ready to move if the data gives them room. What is blocking the path is a geopolitical situation that is keeping energy prices elevated and headline inflation high. That is a different kind of weight, and it is worth explaining that distinction clearly to anyone who is sitting on the sidelines. What the supply chain data is telling us, beyond the oil price story, there is a longer-term inflation risk building in the supply chain that is worth watching. Logistics costs, transportation, warehousing, and inventory are all rising sharply. Transportation pricing just hit its highest level since the Russia-Ukraine conflict in March of 2022. Warehousing costs jumped, inventory costs jumped, and forward projections are not showing any relief. Why does this matter? Because supply chain cost increases do not stay in the supply chain. They work their way through to prices consumers pay, typically with a lag of several months. These pressures persist. The cleaner inflation picture we are seeing in the core data today could get complicated again later this week. This is one of the things that makes forecasting in this environment genuinely difficult. The data we have right now looks encouraging on core inflation, but there are upstream pressures building that have not shown up yet in the consumer numbers. Featured tools this week. We have 4 resources in the dashboard this week that are worth your attention. The first, your CPA's write-offs are blocking your loan. Here's the workaround. If you work with self-employed buyers or business owners, you already know this conversation. Their tax returns make their income look smaller than it actually is. This resource walks through how we address that, and it is one of the most common situations we see with referrals from this audience. The second is from bankruptcy to homeowner in 2 years. Here's how families are doing it. There are more people in this situation than most agents realize. 2 years out from a bankruptcy is not the end of the road. For the right buyer with the right plan, it can actually be the start of a very achievable path to home ownership. Third, from believing the myth to making an offer, how one family stopped waiting. This one is particularly useful for buyers sitting on the sidelines because they have convinced themselves they cannot qualify. Sometimes it takes one conversation to change that. This resource helps that conversation. And fourth, from $1,350 a month in debt payments to $380 and finally breathing again. The numbers say it all. If you have clients who are carrying heavy monthly debt obligations and feel stuck, this is a resource worth having in your toolkit. The featured calculator, the HELOC calculator. This week we are featuring our HELOC calculator from our financial calculator suite. The HELOC, a home equity line of credit, has 2 distinct phases, and honestly, not every homeowner or a very professional fully understand how they work together. The first phase is the draw period. During this period, the borrower can pull funds as needed up to their credit limit and typically makes interest-only payments. It functions a lot like a credit card secured by the home. The payments are relatively low. The flexibility is high. The second phase is the repayment period. Once the draw period ends, the line closes. No more draws, and now the borrower is making full principal and interest payments on whatever balance remains. Those payments can be noticeably, sometimes significantly, higher than what the borrower is making during the draw period. That shift catches some homeowners off guard, particularly if they drew heavily on the line and are now facing a much larger monthly obligation. Showing a client these 2 phases side by side with their actual numbers is a very different conversation than just explaining it verbally. It makes the math real. It helps them plan, and it helps you position yourself as a resource who is thinking past the transaction. If you'd like access to our financial calculator suite, just ask. Here's what to watch next week. Monday brings existing home sales for March. The forecast is 4.01 million units, down slightly from 4.09 million the prior month. This will be an important read on where buyer activity stood heading into the spring season before the current rate environment fully set in. Tuesday is PPI, the Producer Price Index. This is the wholesale side of the inflation picture. After this morning's CPI data, PPI will either reinforce the improving core trend or complicate it. Worth watching closely. Wednesday brings the Mortgage Bankers Association mortgage applications data, along with NAHB Housing Market Index. Builder sentiment has been running very low levels, and this week's reading will tell us whether conditions in the field are shifting at all. Thursday includes jobless claims, the Philadelphia Fed Business Index, and industrial production. The claims data in particular has been holding relatively steady despite everything going on, and any meaningful move in either direction would get attention. And throughout the week, we have multiple Federal Reserve speeches on the calendar. With the current uncertainty in the market, any signal from Fed members about their current thinking on rates or inflation will be worth noting. A note on this week's resources. The featured articles and tools in today's presentation are available on the right side of the dashboard if you are on a desktop, or below the video if you are on a mobile device. If you'd like access to our financial calculator suite, just ask. We appreciate you listening, and we will speak to you again next week. Have a great weekend.